Okay, this is a question similar. Maybe if we could consider this a follow-up question to what happened last week. Last week we discussed a little bit about getting the best profit on an Iron Condor, how to use power options to maximize the return on Iron Condor. Of course, what we discussed in that presentation, which is available in the archive here, we can go to the option strategy section, maximizing returns on Iron Condors plus rolling bull put spreads. Well, Duane's question that he just posted today is a little bit different, and Duane wants to know what is the best way to defend an Iron Condor and best time to defend one side of the Iron Condor as well. All right, so what is the best way to defend it and the best time to defend it? Okay, well, let's take a look here at a typical Iron Condor structure first. As we all know, the Iron Condor, and if you don't know, we're going to review it. The Iron Condor is a combination of selling a bull put credit spread and a bear call credit spread on the same stock with the same expiration date. Typically, your stock will be trading right between the two short strike prices. So I sell a call here, I sell a put here. Both of them might be equidistant from the stock price unless you're trying to skew a bullish or bearish direction. In our conversation last week, I said that I don't bother with a skew. If I think a stock is bullish, I'm not going to go maybe 3% out of the money with the bull put side on the short option, usually what I reference, because that's going to be my trigger point, Duane, when we get into the conversation. But the sold option here, the short option, I'm not going to go just 3% out of the money on the bull put side and maybe go 9% out of the money here for only 5 or 6 cents because I'm trying to skew it to a bullish move. I'd rather just do a bull put credit spread on the stock and not worry about the Iron Condor if that's the sentiment that I have. Yes, it's attractive to take in 2 premiums, but if you do have a bullish or bearish slant on a particular security or even an ETF, it's better to just use one spread or the other, not combining them both to try to figure out what's the range where one won't hit the other. In last week's conversation, I mentioned that I actually haven't legged into or traded an Iron Condor in about the past 2 years because the market conditions did not look right as we were going lower left to upper right through 2017. 2018 was a mixture of 6 negative months and 6 positive months. So it was all over the place, and those negative months were really steep. Would have been hurt on the bull put side, and I did get hurt on my bull put spreads. But in any case, I treat the Iron Condor similar to the way I would treat a standard vertical spread. So here we are, here we got the stock price right in the middle of the strikes. So whether I'm in a bull put or a bear call, what I typically look to do is if the stock reaches in about 1% of my short put strike price, we call it the 1% rule, sometimes it's 1.5%, but if the stock reaches within 1% of the short call or the short put strike price, I might consider managing the position. That might be my trigger. Some investors like to use the idea of twice the net credit or 3 times the net credit. What do I mean by that? We've got our 2 spreads open. We took in a net credit of, say, 50 cents. So I'm going to set a 3x close on this position. What does that mean? That means if the net debit to close one side of the spread or the other, let's assume we're using a 5-point spread on both legs. So if that ever reaches $1.50, 3 times what I originally received, I may look to close out the position or adjust the position. I don't particularly like to do this. And the reason why is if the volatility across the market increases due to any kind of geopolitical event, someone firing rockets into the Pacific Ocean or something along those lines, different kind of news coming out from the Strait of Hormuz or anything like that, the implied volatility, the VIX, the volatility in the market could shoot up. And even without the stock moving, the prices for my short options could increase drastically. And the longs might increase as well, but remember, since we're closer to at the money on the short options, they're going to go up faster. So I might hit this 2 times or 3 times trigger, even though the stock's doing exactly what I want to. There are investors who teach this. There are investors who use power options that use this as part of the rule for their credit spreads, Duane, and their Iron Condors. I just worry about it because of the fact we talked about it before, we're in sort of a headline-driven market. Any new headline comes out during the week that could cause the markets to fluctuate drastically or the volatility to spike without even the markets necessarily moving. And you could be at your 2 times or 3 times, then 2 days later it's right back to where it was and everything is calmed down from the overreaction. Now, another thing that comes into play, and you probably have this already set up, Duane, for your trades. When I'm in a bull put spread, what I usually do when looking for a bull puts, I have certain criteria that I use in the bull put weekly default search. That's what I use in order to trade bull puts in my account. I take usually the top 3 on Monday afternoon and apply that to a portion of my account. But it's looking for things such as a positive MACD, crossover recently, maybe a stock that's at or near its upper Bollinger Band and above the 20-day moving average. So if I see any of those triggers hit, where the MACD goes negative, the stock falls below the SMA 20, I might use that as a predictive means to adjust or roll or do something with my bull put spread. And if reverse, if I'm in a bear call and the MACD goes positive or the stock jumps up the 20-day moving average, opposite of what my criteria were, I might use that as a trigger point to manage the position as well. Now that doesn't relate directly to Iron Condors, but if you're using a channeling Bollinger Band, meaning one of the filters that we have in Power Options, of course, you can look for the percent BB20, the percent Bollinger Band width too, to be between 30 or 40%. So it's a lower width. It's been a condensing stock. But if the Bollinger Band width suddenly spikes, that might be your indicator. If you use RSI, you look for a mid-range RSI or something along those lines, but the RSI breaks above, let's say, 70 or breaks below 40, and that might be your trigger to see it's going in the wrong direction, or stochastics or anything like that. So if the criteria that you use to get into the position, and by the way, this could also relate to the options positions. If you use percent probability between, it's one of the filters that we like to use here. Let me go directly into our search here in Power Options. Okay, so for the options criteria, I might use the percent probability above the short put strike, percent probability between the strike price as high as 80 or 85. You could also maybe use a delta. If you're using a delta on your 2 short options, the call or the put, say a delta of less than 0.3 on the sold call on the upper wing, well, if the delta goes to 0.4 to 0.5, that's probably going to be your trigger point to roll. Okay? For me in these type of spreads, I'm showing you what is possible, what is likely, what some investors use. I don't like using the monetary amount of the spread because of fluctuations and volatility. I prefer to use the indicators that I would use to get into the strategy, whether they're technical or the indicators on the options themselves. If during the trade, my probability between, the stock moves one direction or the other, my percent probability between drops to, let's say, 65%. Would I open an Iron Condor if that theoretical probability between the strikes was lower than 70? No. So why would I want to stay in a trade where that's now the case and it's looking like it's still continuing that direction? Okay, these are all trades for 14 days out. Let's go to BA here real quick, and we'll just go to the profit and loss chart, get a better visual there. Okay, so this one's not bad. It's a 44-cent net credit on a 2.5 point spread. See, as I mentioned, it's this one's a little bit skewed, but it's sort of right in the middle of the 2 strike prices because I'm not trying to gain a bullish sentiment or a bearish sentiment in that situation. So again, when would I look to trigger it? When the stock moves within 1% of my trigger. It's always going to be based on the short. So we sold a 327.50 put. 1% of that's going to be about $3, $3.30. So if the stock drops, let's call it $3, if the stock drops down, it's currently at $3.46. If it drops down to $3.30.50, I might consider managing the bull put spread, adjusting it, getting it out of the way. On the other side, we're at $3.70 here on the short call. So if the stock moves up, we just subtract it out. It's about $366.30, a 20-point move up in the next 14, anytime in the next 14 days. That's when I might look to manage it. That's the 1% rule. So it would be roughly at around 366-ish, so it would be about here, 1% rule to the short call strike, and about here, of course, 1% rule to the short put. Now, in relation to the Iron Condor position, well, okay, that's the first part. Those are the things I would look for, is whatever the 1% rule for me, whatever criteria you're using, whether it's technicals or whether it's even probability or delta. When you say that, hey, I'm not going to open an Iron Condor unless the delta of my short is less than 0.3, and here it's less than absolute value greater than negative 0.3. I'm going to look to do that. So the criteria you use and the 1% rule is what I prefer. You can set it on price against the net credit. You know, if this goes double or triple, as I mentioned, that's not what I'm looking for that. Now, what is the best way to defend it? This gets tricky. There's no real one answer because it's not depending on what the stock is doing now, which is unfortunate, Duane. It's not based on what the stock's going to do now, but what the stock's going to continue to do. Let's say, for sake of argument, I'm in this Boeing position. I opened it today. And next week, the stock falls down to our range that we were worried about there, that 3% to the bull put side. So we get in, it was the 357? No, that doesn't make any sense. 327.50, my apologies, 327.50. Okay, so let's say it drops down to about 330 and I'm in my 1% rule. Now, last week we did talk about this in the sense of a bull put credit spread. But I treat my Iron Condors the same way I treat my verticals, meaning this is the sides it's being threatened. This is looking better. Okay, this side over here, my bear call side, is looking pretty good. It's probably, I can buy it back for probably 5-10 cents in this case and take 90% of the profit I expected on this. But I'm probably losing $2 or $3 over here. So it's going to cost me maybe $150 or $160 loss to get it back. Now, some investors say that just like a bull put credit spread we talked about, so the best thing to do is just, hey, roll the spread. So what's being threatened? Your short put. Let's just move this whole bull put down here. Well, keep in mind, I only took in 43 cents to begin with. Might cost me 5 cents to close this side, but let's say we even leave it open. We ignore it for now, Duane. If I roll this spread down and it costs me $1.60 to close, I'm at a $1.20 loss in this position. Remember, we're just ignoring the bear call side for now. So in order to get the $1.20 back just to break even, what am I going to have to do? Remember, this was a 2-week trade, a 14-day trade. Well, I'm going to have to triple that or more. I'm going to have to go about 2.5 to 3 months out in time for an Iron Condor that still has the probability I want, or even a bull put spread that still has the probability I want and a $1.20 net credit. Or we're going to have to increase the strike prices so you're taking a higher margin. Some people say just roll the Iron Condor down and out and keep both legs open. You could do that. You would still likely, a benefit of that is you only have to cover the margin on one side of the spread or the other, but you're going to be going 3 to 4 months out, or you're going to be doubling or tripling the margin. We're going to have to go to a 5 or maybe a 10-point spread to get this $1.20 back. Okay, so that's sort of a little bit rough there. So that's why I look at it as just the spreads itself. But again, the question comes in, and this was touched upon last week, is it better to look for a higher return or a better success rate long-term for higher profits? Our argument was it's better to have a trading plan with a higher success rate rather than forcing positions that have a higher return. So what do I mean by a higher success rate? We want to be successful in vertical spreads probably 80, 83, 85% of the time to profit long-term, and looking at around 11 to 12% on a vertical spread, maybe 18 to 20% on an Iron Condor for 14 days out. Now, where I'm going with this is that with that type of trading plan, if I keep my loss, and in this case, remember, the maximum loss was 207. So if I can get out with 105 or 110 loss, that's about 50%. That's okay. Maybe I just chalk this up to the 17% of the time over the course of the year that I'm going to lose on my positions. And I'm not going to worry about managing this position, which did the opposite of what I wanted, which was to stay neutral. Either some news came out, some other benefit came out as well, something positive or something negative came out, which caused the stock to swing drastically. Or even an ETF, if you're trading Iron Condors in an ETF, which I recommend, by the way. The Iron Condor neutral position, you don't get as much premium on the ETFs, but you're not subjected to sector weakness. A stock in the sector of the stock you're trading with suddenly has a poor earnings and brings the whole sector down. Sure, an ETF might be affected by that, but not as directly. You don't get as many wild swings, which is what we want. We want stable to neutral with this strategy. So if a leg is threatened, I'm going to approach it the same way I would approach managing a bull put or a bear call. And there's essentially about 8 ways to do it. One is do nothing. I've hit my 1% rule. I think it was an overreaction to something in the market. I think it still has the potential to recover in the either direction, so I'll do nothing and wait. I don't really want the short put or the short call to go in the money. So that's, number one is do nothing and hope a little bit. Not the best answer, but it's a answer depending on the conditions that cause the stock to fall to that 1%. And maybe if you only have half a day left, it might be okay to leave it open. And if it goes a little in the money, just close it out before expiration, depending on the situation. Number 2, close and move on. Again, no one wants to say that. No one wants to say, hey, just close and take the loss. But if you have a successful trading plan where you're right 83% of the time, you're averaging, you're only wrong 17%, and you're keeping your losses to 50% of the max, you'd still have a successful track record. Maybe this is just one of those ones of the 17% of the course of the year you're going to take a loss on. Number 3, roll the leg down. And I mean the spread. So I could just adjust this bull put credit spread and roll it down in strikes. But if I'm 2 days to expiration, I've got to move to another expiration date. Okay, and now again, are you opening the Iron Condor or you're doing this? And now we have to ask ourselves, why did I have to manage this position to begin with? Because the stock was going in a direction that didn't match the strategy. Is this still the right stock to trade an Iron Condor if it continues down? Or what if I move this Iron Condor down to try to get, keep it break even by not maybe getting a little bit of it back, but, getting $1.30 or $1.20, which again may be increasing a strike price or going 3 months at a time, but the stock recovers. Now I've got to manage the bear call side. I'm not a fan of this idea of just roll the spread down or roll out. Number 4, of course, and I didn't mean just close the short, the one that's threatening here, I meant close both. You could just close the side that's being threatened without rolling. Now, that's still probably going to be at a loss, but then again, if it's part of your trading plan, you continue on. Number 5, an option is to just close the short put that's being threatened and leave the long open, or the short call and leave the long call open. Why would I do this? Because if something came out that changed my sentiment exactly, it looks like it was going to continue to further down when that trigger hit without going between the strike prices, although this will be expensive, if I still have 8, 9, or 10 days and the stock continues down, well, I'd be sort of in a bear call with a long put profit now that I've closed the short. Now my debit's going to increase, so my break even's probably here, right? Instead of 43-cent net credit, I'm in this type of profit and loss chart up here with maybe a debit of, 120. But if the stock continues down, that long put. And you could buy this side too to free up the margin. No problem with that either. So that's number 5 is just close the short. And then, of course, number 6, I could convert it. If my bull put's being threatened, I could close the bull put side and open another bear call. But now you're double dipping and have twice the margin. That's not a number 6 that I use for the vertical spreads. Close and do the opposite, not advisable for an Iron Condor because now you're kind of double dipping. And if the stock recovers, you might lose on both spreads to that other side. Kind of a risky move. I don't use it for the Iron Condors. 7 is, I know we're going beyond here, but 7 is if the stock's between the strike prices, we can do what's called the pendulum adjustment. I won't go through that right now. And number 8, of course, would be to sell, I don't like doing it, but to sell another spread inside this spread to create confusion. Sort of repairing a condor by converting it to a butterfly, moving the bear call side down for a higher profit to give you more. Let me explain that. I didn't explain that well. Some investors teach that, hey, if the stock's going down this way and the bull put's threatened, close your bear call for a cheap price, and I've only got a 38-cent, and open a new bear call, say here, or as a butterfly with the same strike of your short. You get a bump in profit because the hope is this new bear call is maybe twice the premium than you originally received because you're putting it closer to at the money. Well, grief, you could still lose the full amount on the bull put if it continues down. Sure, you hedged it a little bit by the new premium, but if it swings back up, you lose on this side. It's kind of a tricky one to do because you really have to be confident in your guesswork of where the stock's going to go next. And that's the problem with the Iron Condors, and that's why I prefer to usually just close it out, accept it's going to be part of my 17-20% loss in that case, and then go forward from there. Okay? Now, that's just a quick review, sort of as we did last week, but when we talked about managing the bull put spread. But later on this weekend, Duane, if you have the time, you can go to our webinars page, powerop.com/webinars.asp. I'm going to send it to everyone in the chat right here. There we go. And under the options strategy section, you've got a variety of ones here, but one from September of last year, 8 ways to manage a bull put spread. That's what I would use to manage my Iron Condors if I was in one and the bull put side was being threatened and the idea is reversed for the bear call. I'd use the same ideas but just sort of, in a sense, reversed on the bear call side if one of my trigger was hit, the 1% rule or the triggers for the criteria that we were using. If you're trading a spread that's 30 days out in time, you're not doing shorter term weeklies, 2 weeks out, for example. I prefer to use 2 weeks out for vertical spreads based on the research I've done. My apologies, but if you're going 30 days out, you can probably use a 1.5% rule because you're going further out of the money. But if you're using only a 4 or 5 day out trade, you probably want to set that to a 0.5% because you probably couldn't go that far out of the money. And it's taking a little bit more risks. You didn't get as much premium up front. Hope is the shorter time helps the trade, but depending on the week, you might see wild swings and be at a loss before you accept it. All right, so that's my answer there, Duane. How I would manage and trigger points I would use for an Iron Condor and ways I would consider managing. Hey, thanks for watching. Remember, you can take a no-risk 14-day free trial anytime. You'll get full access to all of our patented tools for finding, comparing, analyzing, and tracking positions. Don't know where to start? Take advantage of our 4 steps to get more familiar with the tools, access webinars. Just go to poweropt.com and start your trial today.